Peter, thank you very much for your time today.
Sure.
Now, Peter, what are the implications of rising inflation on company profitability, particularly within the US? You were explaining this at the conference.
Yeah, look, we try to distinguish within the news. There's a lot of news lately. There's a lot of talk about tariffs, and that's very interesting and it can be relevant. But again, we try to focus on what does it mean for the investor. So really, you can read a lot of the news, trade war, tariffs, as a consumer, or as a voter, if you're sort of if it impacts your political views. As a consumer, you may be paying more for things, right? But as a shareholder, it's a very different lens to be looking through these things. And one of the important implications, I think, is if you got these tariffs coming through, and there's visibility on these things, like tariffs becoming effective in January. Well, people that have been watching inflation and the Fed and interest rates, for a while, and the Fed has to be very anticipatory about these things. They have to start raising rates before too much inflation shows up. And obviously, they've got scheduled sort of anticipated interest rate increases next year. Well, if you add tariffs onto that, so it's very visible, again, January 2019, tariffs coming online, things like consumer goods costing more. Well, that adds more to the argument that inflation may be likely, may be on the horizon. And again, as investors, we're thinking, okay, baseball caps may cost more as a consumer, but really as an investor, it's a different lens. So barriers to entry aren't necessarily bad, right? So like the Morningstar equity research, moats and competitive advantages. Really, we don't rely too much on the PE multiple, but it's not a bad signal of companies that might be in trouble just on an earnings yield basis, earnings relative to what you have to pay, compared to rising interest rates.
So you're talking there from a bottom-up perspective in looking at the company fundamentals. What about if you're thinking from a sector perspective? And at the conference, you're talking a bit about, I think, consumer cyclicals was one area that you mentioned as something that may look a bit more appealing to investors as inflation continues to tick upwards.
So consumer cyclicals or consumer staples, what we look for pricing power, right? And that shows up in different ways. It can be in the consumer staple side of things, or it can be in the luxury side of things. And when you think about, and again, this is very important for inflation. So this type of stock selection, really, look, it hasn't mattered that much in recent years because all the markets have gone up, and Netflix and Amazon have been up just like Microsoft, right? And so when you go on the consumer side of things, if you've already got that pricing power, and there are famous examples. So Professor Greenwald at Columbia liked to talk about WD-40. People think, oh, geez, the pricing power in this example is quite interesting. People think, oh, there's some kind of magic formula in WD-40. Actually, there isn't. And WD-40, and it's not like it's a huge business. Any large chemical company like Dow DuPont could go in and make it any day.
I guess it's that point with consumer staples as well, that if inflation rises, consumers have got less money in their pocket for the discretionary items, but they'll always be buying those staple products. And is that something that you're thinking as well? You
can go that way, but there's some unintuitive. People think about luxury, like that's true, but some consumer staples, there actually are competitive pressures where, like Kellogg's is disappointed recently, and I think sold down overnight. Some things don't stack up. Some things are subject to competitive pressures. Even the famous Coke example, who knows how long people will be drinking that. Some of these companies, though, they have the resources to diversify and to adjust to consumer preferences. But consumer staples, again, you got to think about pricing power, robust demand versus limited supply. If you're just out there supplying a commodity, and this gets back to actually the tariffs on steel and aluminum. If you are a business owner where you actually need the help of tariffs, you're supplying a commodity, that's not a great place to be as a shareholder. You're looking for a profitable company. And in luxury goods are a good example. People think, oh, there's recession, and people are going to stop spending money on luxury goods. Well, not necessarily. People can afford it, can probably still afford it. And if you have this business of where you emphasize profitability, say over growth, a lot of times those are, businesses try to grow at the expense of profitability. That's not what we're looking for. We want companies that prioritize profitability over growth, because that's how shareholders actually get rewarded. And luxury, again, if you can sell a handbag for $5,000, then you should stick to that business. Don't worry about growing it too much or sort of, compromising the brand there. That's what you should do, and that pricing power is something that works quite well for shareholders over time.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.